Think about gold and silver. When the economy falters, consider investing in precious metals such as gold and silver. When other investments suffer, certain metals tend to keep their value. You may invest in them by purchasing physical gold or silver, or by using related investment choices such as ETFs or mining company stocks. They are appealing during difficult times because they have intrinsic worth. Gold, for example, is rare and difficult to mine, making it valuable by nature. It is not subject to the ups and downs of the economy, as are certain other investments. People also see these metals as a secure method to keep their money. When traditional investments become insecure, many people resort to gold and silver to protect their savings. Furthermore, these metals have a worldwide appeal. They are not reliant on the economic state of a single nation, making them an excellent option during a global economic slump. Make sure you watch until the end of the video. Number 1 might surprise you. Without further ado, here are 9 signs a terrifying housing crash is about to burst. 9. Risky mortgages may set off a chain reaction. As large financial institutions grow more cautious about borrowing, smaller enterprises with lesser credit criteria enter the market and provide riskier mortgages. When lenders relax underwriting criteria too much, such higher-risk mortgages might create a housing catastrophe since they may be issued in large quantities to purchasers who cannot afford the properties. That's exactly what occurred in 2006 and 2007 when there was a subprime lending boom that fueled the housing implosion, the financial crisis, and, of course, the Great Recession. Despite the fact that additional mortgage legislation has been implemented since then, and banks have been compelled to raise lending standards, developing businesses have continued to ignore certain needed information and documents about the borrower's capacity to afford the house, credit ratings, and down payments. When conventional borrowers begin to reduce credit limits, their services become more popular. Because their data is in public, it's impossible to know how huge the issue is until it gets much too enormous to ignore. 8. Mortgage lenders are becoming concerned. Most of us require a mortgage to purchase a home, so when borrowers tighten credit terms, it's an indication that the market is on its way down. You may also look at Fannie Mae's quarterly lender mood survey to see how lenders are feeling, how they're reacting to current trends, and what they anticipate happening in the market. This poll measures lenders' projections for profit margins, mortgage loan demand, and mortgage refinancing demand. According to the most recent data, mortgage lenders are beginning to limit lending availability as losses continue to increase. According to the Mortgage Bankers Association, the delinquency rate for mortgage loans on 1 to 4 unit residential buildings grew to a seasonally adjusted rate of 3.62% of all loans outstanding at the end of the third quarter of 2023. Overall, the delinquency rate increased by 25 basis points from the second quarter of 2023 and by 17 basis points from a year earlier, which is a concerning trend for the industry. 7. Realtors and house builders are also gloomy. Real estate agents can see problems as they arise. As a result, their expertise is incredibly essential, particularly during crucial situations. According to the National Association of Realtors' Confidence Index, the number of agents expecting an increase in buyer traffic over the next 3 months fell to 8% in October, down from 11% the previous month. From August to October, sentiment dropped from 72 to 64 points. Furthermore, builder confidence sank to its lowest level since January of the previous month. The monthly National Association of Home Builders Wells Fargo Housing Market Index fell 4 points to 40 in October, with September's reading revised down 1 point. Anything less than 50 is seen as unfavorable. This was the third consecutive monthly fall in builder confidence. Builders have reported decreasing levels of buyer visitation as increased mortgage rates have pushed some buyers out of the market, especially younger buyers. Elisa Huey, AHB's chairman and a house builder and developer from Birmingham, Alabama, exclaimed. 6. Buyers are not feeling secure at the moment. The prospect of a house market catastrophe may be quite unsettling for a homeowner or a buyer. The last thing you want is to oversee a massively overpriced asset when the economy is collapsing. One strange aspect of the economy is that it is a self-fulfilling prophecy. If people believe that the housing market is not doing well, there is a significant likelihood that it will crash shortly. When individuals consider that circumstances are unfavorable, it indicates that they do not plan to purchase a property right now. Fannie Mae's monthly consumer mood survey, which asked respondents whether it's a good time to purchase or sell a property, may provide insight into how people feel about housing. And why is this so? The study found last month that 85% of consumers believe it is a terrible time to purchase a property, with the majority citing inflation and high mortgage rates as the top reasons. That was the lowest level of consumer confidence in 11 months, in a confirmation that housing demand was cooling throughout the nation. 5. Shadow inventory has the potential to transform the game. In addition to apparent listings, there are homes known as shadow inventory, or properties that are not officially listed but might possibly reach the market at any time. According to Redfin, about 5.5 million homes fall into this group. If a large number of shadow houses suddenly become available for purchase, the market may become oversupplied, causing prices to fall. This shadow inventory includes distressed houses for sale or residences kept by sellers awaiting better market circumstances. Explains according to Rakita Ashrani, owner of Century 21 Martin Real Estate. The recent surge of these properties has the potential to increase market competitiveness and put downward pressure on pricing. In the coming months, she added. 4. Property sellers and builders are slashing prices at an exceptionally rapid pace. According to Zillow and Redfin statistics, a record number of sellers reduced the prices on their listings in the last quarter. In September, the proportion of house listings with a price reduction increased to 9.2%, and in October, that number increased by 7%, an extremely high month-over-month rise, according to experts. Furthermore, the National Association of Home Builders said that 32% of home builders reduced prices in the previous month, with a countrywide average reduction of 6%. 3. After months of fast increase, home sales are dramatically declining. When house sales decline precipitously after rising steadily year after year, it might signal the beginning of a housing market crisis. This is because decreases in sales volumes may have an impact on house value. When enough sellers are unable to find a buyer for their house, they will be forced to drop the price to attract additional bidders. Home sales decreased 15.1% in the third quarter, bringing the number of existing houses sold to levels not seen since the Great Recession's aftermath. Many would-be purchasers are presently priced out of the market, with mortgage rates approaching 8%. This is forcing sellers to dramatically cut their asking prices right now, which brings us to the following indicator. 2. Mortgage rates are absurdly high and are unlikely to fall anytime soon. However, since the Fed has vowed to keep rates higher for longer and has hinted that further rate rises would be required to bring inflation down to its 2% objective, mortgages will stay costly for much longer than expected. The current national 30-year mortgage interest rate is 7.87%. That is the greatest level in the past 23 years. According to Black Knight, this is causing the typical new buyer to spend about $3,000 per month for their mortgages. In comparison, the typical American makes just $4,600 per month, making that substantial portion of a payment unsustainable for most people and negatively hurting demand at a time when more supply is entering the market. 1. From the epidemic until the end of last year, the period of unsustainable price hikes is finally over. Home prices in the United States increased at the quickest rate in history, rising from $329,000 in January 2020 to a stunning $479,500 in December 2020. That's a whopping 45% rise. Without a comparable growth in salaries at this time, it was evident that the U.S. home market had entered a gigantic bubble. However, prospects began to worsen this year when the Federal Reserve boosted interest rates to levels not seen since the turn of the century. This sum dropped to $441,000 at the end of the first quarter of 2023, then to $429,000 at the conclusion of the second quarter. The average house sold for $406,100 in the third quarter, indicating that the tendency that held prices at unsustainable levels for many months is no longer in force, while a new trend of price decreases is swiftly spreading throughout the United States. Thank you for taking the time to watch. Please remember to use the like and subscribe buttons if you enjoyed the video. We'll see you in the next one.